Don't put all your eggs in one basket. Everyone has heard of this, and yet sometimes we hear about either people we know or in the news about people who have lost all their life savings either in a market crash like the 2008 crisis or in a scam or something. Why does that happen? Is it because they were trying to get rich too quick, or they weren't mindful of the principles of asset allocation? Hi, I'm Hansi, and we are learning to be money mindful. In this episode, we will talk about asset allocation, which is the technical term behind the saying, don't put all your eggs in one basket. We will learn about what asset allocation is, the different types of asset allocation, how to do it, and most importantly, what to be mindful about. Let's get started. So what is asset allocation? Simply put, it's basically how your wealth or portfolio is split between different asset classes. Asset classes being equities and debt and real estate and gold and so on. But notice that I said wealth or portfolio. Actually, financial advisors differ on whether they should refer to wealth, because wealth includes your own home, it includes your own business. If you work for a startup, it includes ESOPs. These are things that usually are so dominant in your net wealth that they dwarf the rest of your wealth. So some financial advisors exclude these things. And that's why I said wealth or portfolio. So when they exclude these things, it's referred to as your portfolio or your investable portfolio or investable assets. That's what most financial advisors deal with, your financial wealth. So leaving out these lumpy things. So when they're doing asset allocation, it could be based on your wealth or your portfolio. Which one is more relevant? Well, that's a debate that's been going on for decades. Personally, I think I do want to include wealth. I'm in the camp that when you buy your house to live in, it does represent a big part of your wealth, so therefore I'm conscious that that exposure is to real estate. So I don't want to double up in my portfolio, or the fact that I will not overpay for my own house. But that's my philosophical view. Some financial advisors exclude at least the principal residence when they calculate asset allocation. The other thing that you have to be mindful about in terms of asset allocation is that most financial advisors are putting your asset allocation in the context of financial modeling. Remember, I said there are three approaches to financial planning. One is the timeline approach, where everything is put on one timeline. The second one is the goals-based approach, where you match goals with assets. And the third one is the rule of thumb approach. The other thing you have to be mindful about is that practitioners sometimes include in asset classes what are actually segments. So for example, within equities, there is large cap, mid cap, small cap, which is segments. In India, because we don't have that many asset classes that we can invest in, the practitioners will call these asset classes. But here's the thing, they all get affected by the same market fall. Similarly, if you spread between government debt and credit and so on, it's false asset allocation, it's false diversification. It is just sort of diversifying within segments. So you have to be mindful that you are not pretending to diversify when actually you are doubling up on the same thing. The other thing to be careful about is that when people refer to asset allocation, they mean strategic asset allocation. As the name suggests, you need to be strategic, i.e. long-term about this. So what they're saying is, to meet your long-term goals, what is the asset allocation that will give you the highest return for your given level of risk? The given level of risk is usually tied to your risk profile. So if you are young and you have decades to go to retirement, you may be risk profiled as aggressive. Remember, risk profile is a combination of your need to take risk, your ability to take risk, and your appetite to take risk or tolerance. So you may be aggressive or you may be moderate, but the idea is that you have time. Whereas if you are older and you have less time to retirement, you might be classified as conservative. So therefore, you will be given a strategic asset allocation of more in bonds or debt and less in equities. So your strategic asset allocation is tied to your risk profile. Your SAA also assumes that markets are normal, that they are not out of whack. The returns will be what we expect in the long term. So equities will be inflation plus GDP plus sort of a margin, and debt will be less than that. However, here's the thing. Markets are never normal. Markets are either overvalued or undervalued at any given time. So if the practitioner, the financial advisor, believes that they're over or undervalued, they may suggest to you a tactical asset allocation. And that means that we will do something different because we think the markets are over or undervalued. Within the next 12 months, they're likely to snap back. So we will take a deviation away from your strategic. So even though long term we think you should have X% in equities, but right now because we think markets are overvalued, let's put less in equities or let's drip feed in over a period of time. So that is called tactical asset allocation if you are timing the market. Now, market timing is very hard. It is usually wrong. Most people who try it don't get it right. So there is an in-between approach which is called dynamic asset allocation. It's more medium term. So in tactical, we are making short-term forecasts within 12 months. But in medium term or dynamic asset allocation, we're not making forecasts. We're basically saying that we know markets are overvalued or undervalued, but we don't know the time frame in which they can snap back. It could be 6 months. It could be 3 years. Yes, 3 years. Sometimes markets tend to run, the bull runs run for a few years before the bubble is burst. So dynamic asset allocation kind of recognizes the fact that markets are over undervalued, but doesn't put a time frame to it or puts a more medium-term time frame to it. So the three types of asset allocation are strategic, tactical, and dynamic. And they represent your allocation tied to your risk profile, to market over undervaluations, and a more medium-term approach. Now let's talk about how to do asset allocation. Most practitioners basically do a long-term or a strategic asset allocation for various risk profiles, and then they take those deviations over underweight, as I said, in the tactical or the dynamic asset allocation. So how do you come up with the strategic asset allocation? So say I say I'm moderate or balanced risk profile and I therefore want to achieve, say, just about 10% returns. How do I get there? What practitioners have to do is to forecast long-term returns from all the asset classes that they're putting you into. So equities and debt and real estate and gold and so on. And then they also have to put in volatilities, so risk, as well as correlations in terms of how those asset classes move together. So these three terms, expected return, expected risk, and expected correlations, is what goes then into a mathematical formula and out comes what the most optimal mix is, such that the portfolio risk is minimal for a given level of return. Now, all of this, by the way, came from this book, okay, by Harry Markowitz, who got the Nobel Prize for this. It's called mean variance optimization or modern portfolio theory. So anytime someone talks about efficient frontier or a scientific modeling and so on, this is what they're referring to. Now, modern portfolio theory is not modern anymore. It was actually written in the 60s, 1960s. While the math is still valid, what has been pointed out over the years is that while expected return is hard to predict, it is doable. Expected risk or expected volatility and expected correlations are much harder to predict. And therefore, most people don't even try. They take historical volatilities and historical correlations. And then when things don't work, when crises happen, all correlations go to 1, which means all of them move together. So equities and debt, like in 2022, they all fell. That is what is the problem with scientific modeling, that it is taking historical data. There is another approach that is more prevalent now, which is taking a factor approach, which is basically saying, let's diversify across different asset classes based on interest rate risk sort of affecting bonds more, to some extent equities. But then there's economic or GDP risk, there is corporate profit risk, and so on. So they take much more qualitative approach to diversification or asset allocation. So they're the two ways. One is called mean variance optimization by taking the mathematical formula, and the second approach is a more factor-based approach. I kind of lean towards the second, which is much more qualitative, but much more intuitive to understand. Now let's talk rebalancing. So basically, once you put so much effort into doing the strategic asset allocation, splitting it in various asset classes, in a year, maybe even 2 years, markets will be such that your allocation will get out of whack. Okay, so equities, if you started with say 50%, it could have gone to 60, and debt would have fallen to 40 or even more. So how do we set things back? Simply put, how do we put things back to the way they were? Because that's what is going to achieve our long-term goals. So there are basically two ways to do rebalancing. One is time-based and the other one is deviation-based. So the time-based one says that maybe once a year or every 6 months or every 2 years, but basically once a year is more than enough. You sit down and you see how it's gone out of whack and you put it back. The second is deviation-based, which means that if, for example, there's an extreme event in any given year, you might exceed 2% away or 5% away or 10% away from your intended or strategic asset allocation, and that is far enough, so you should be put back. That deviation-based is what fund managers do in their multi-asset product or hybrid products. But for most people like you and me, seeing a financial advisor and doing a time-based one once a year is more than enough. So let's do a recap of what we learned today. We learned what asset allocation is. So basically the spreading across asset classes. We learned that there are 3 different types: strategic, tactical, and dynamic. We learned that there are 2 ways to do it. There's the modeling mathematical approach called mean variance. And there's also the factor-based approach, which is much more subjective, qualitative, and intuitive, but still needs practitioner. We learned that we can rebalance either on a time-based, say once a year, or deviation-based, say 5% away, and so on. But what you have to be mindful about is whether the asset allocation is based on your wealth or on your financial portfolio. That's one. The second thing you have to be mindful about is that the asset classes are genuine asset classes rather than segments. It's better to add additional asset classes like international equities or international currencies, basically spreading out as much as possible rather than pretending that sub-asset classes or segments are diversification. And thirdly, you have to intuitively understand the asset allocation or the spreading of risk. Because that's in the end what we're really doing, spreading risk. That's how we build wealth slowly but mindfully. This asset allocation is not going to get you rich, but it will ensure that you do not lose everything. You know those stories that you hear that someone lost all their life savings in some bond or some scheme or some scam? That won't happen if you follow asset allocation. That's what we're mindful about. See you in the next episode.